Smart money versus dumb money. One of your favorite indices is back in today's video as we take a look at the biggest earnings season that we've seen in years. Yes, what Wall Street and the Darkpool liquidity is up to right now will absolutely blow your minds. But maybe more importantly than any of this, can gold, our shiny metal, continue up? Or is it about to hit what we call a blow off top? Well, in today's video, we take a look at over 30 years of history to try to break that down together, and the results may absolutely shock you. Stocks, commodities, and cryptos, so much to go into, and some huge options flows. Let's go through it all right now in our special weekend edition. See you in a minute, guys. This one is not to be missed. Well, welcome back everybody to the special weekend edition of our daily show. My name's Tom, and in today's video, we have one that's jam-packed. The latest macro, the data, the key levels, the options flow, and of course, what is Wall Street up to right now? Let's kick things off with 100 years of equity market concentration. But just a reminder, if it's your first time here, remember to subscribe and smash that bell icon, as this could be the most important week we've seen in earnings in years. Now, let's talk about concentration for a moment and some of the bad signs in markets right now. Then we'll go through the good ones, and of course, then we'll go through the big trades. Speaking of which, market capitalization is really concentrated, and this will come as no surprise to anyone that's been looking at the 2000s period and potentially the really bad one, the 1930s, where we saw several large businesses become a huge part of the market and obviously a massive crash after that. According to the latest Goldman Sachs data, we are in pretty much the highest level ever, even still after this fall off that we've just seen, entering into what we call a technical bear market. Now let's go through some of the bad signs. The first one has to do with home builders. Now we've been talking about this for a while, but as you guys know, home builders can sometimes foreshadow problems in markets. They can also be used to pick up potentially dips. Now we have not seen a strong result so far in home builders as the markets continue to sell off. And as many of you would know, the number one largest trade we've ever seen in home builders happened right at the peak at the end of last year. So why is this important? Well, if this continues to degrade, we can kind of assume that markets will start to follow at some point in the future. And it is a very good lead indicator, and of course a worrying sign of the potential of a recession just around the corner that market structure will probably make a very big decision on soon. So let's talk about why that could be. Well, traders are plowing $6.6 billion into leveraged long ETFs. And you might think, well, that's good. It's probably Wall Street. No, it seems to be coming from retail. Now, the big problem here is that retail on one hand are answering surveys saying that we're freaked out more than ever before. But on the other hand, buying the dip more than ever before. And why could this be? Well, it's got to do with conditioning. Now, of course, not every dip is the same, but there are some historical stats that have been out there before that have obviously shown us that buying the dip pays off. And of course, if you know your historical stats, you would know that's traditionally correct. But are we in something worse? The concentration bubble that leads into something like a dot-com crisis. The AI bubble, the dot-com bubble, are they looking the same? Well, of course, if you overlay this classic chart, which is NVIDIA versus Cisco during the heights of Cisco back in the 1990s, you'll notice that we are at a turning point. If markets turn up here, okay, maybe it's just a pullback and we follow a different path. But if markets continue to stay up, down, and all around, and then eventually break towards the lows, well, yeah, that's not going to be a good sign at all. And in fact, this is actually going to be the average type of recessionary move that we tend to make 6 to 9 months after the first Federal Reserve rate cut, which of course we did see back last year. We've got a big special on that coming up. I'm just collating the data right now, and yeah, it's pretty shocking. Now, speaking of which, worse signs still. Well, we just had over 11 days of the VIX above 27.3. Now, this doesn't mean necessarily that the markets are going to end red, but it certainly increases the average odds. In fact, when you are looking at an end of year being red, traditionally, you will always get it only when you have that 27.3 times at least 11 days. That has now happened in 2025, so it opens the case of some of the worst total year returns that we've ever seen. Now, should we be panicked about that? Not necessarily, but it's certainly another bad sign. Another bad sign on top of this, if you believe them, is that Wall Street banks are cutting their end targets. Now, we posted this over on our X account, links in the description down below, by the way, if you want to follow us there for the latest charts, and have a look at all these switches. Now, I think only a few analysts are actually upgrading. I think one guy's gone to 8,000, not a Wall Street analyst, but still a bit of a contrarian. Some of you will know who it is. And then on top of this, we have many people going in at around 5,500, 5,600 zones. Now, just remember, these are all not worth anything. Now, you might say, well, the average target is something I use to look towards for the end of the year. Fine. But realistically, you can see here the huge shifts that tend to happen. And this is, because you're allowed to make changes, of course, when things shift. But at the same time, this is why targets are not necessarily worthwhile paying that much attention to. Instead, we should be looking at price action, flows, and of course, the data itself. Now, it takes bulls to have a bull market. Yeah, you probably say no duh. But what that actually means is a lot of the time when you're looking at these sentiment survey results, especially the spread, which we've been doing over the last couple of years, we do want to see this spread start to improve along with the price action low bottom. Now, that doesn't mean you're going to get the low of the market. If you're trying to pick the low, well, of course, you're not going to get that with these spread differentials. But just remember, when you tend to have the spread much higher, you're in extremely good bullish periods in history. And this can be very helpful when you're in the middle of what we call a bull cycle. So one of those things that lasts between traditionally 4 and 7 years. And of course, we are currently, one of the lowest reads that we've had at all times. Now, as we've already mentioned, a lot of people are answering these surveys and saying, look, I'm really fearful, but at the same time, it looks like retail traders anyway are piling into leveraged funds. TQQQ in particular, which is the NASDAQ triple leveraged fund, that is getting so much money being put into it. And as Grant Hawkridge has done over here, what he's taken is a whole bunch of different components of these particular bull bear kind of sentiment survey reports and other things. And he's found that we are not yet at what we would consider an extreme fear pickup zone. So have we hit to a critical level that traditionally is a good buy the dip? Yes. But have we hit extreme fear? Not by most records. And this can take some time. And this is a really good one that will continuously update throughout time. Now, as we mentioned, smart money versus dumb money. One of the favorite indicators here on the channel for many years by you guys, provided by Sentiment Trader. Obviously, I had to bring it back for this particular time. Have we hit a critical point? And you'll notice here that traditionally, when smart money's been going absolutely ballistic, then you may want to be looking at potentially some dip buys. But I think the most important thing about this is something weird happened. And as Cole Garner here posted, it looks like smart money versus dumb money confidence spread hit this such an extreme high based on this indicator, which obviously has many metrics in it, that we have effectively seen it only one other time. When was that? Around the dip of the final dip in 2007. Now, it gives you some food to thought when you're thinking about the conditioning that we always have to buy the dip indeed. Well, we always know that the Federal Reserve, or we have always known that the Federal Reserve generally has been there to support the markets. Are they there this time? It's a great question to ask. And we usually know as well the government is supportive of a bullish market itself. And that's another one we have to ask ourselves the question for in 2025. Now, what is happening here is all the traditional signs of a dip low. And this is where you start to get these flows into money markets. Now, you can see here the latest macrocharts.com cash flows into money markets does show you that we are entering into a period where traditionally we've found at least a temporary bottom. And I say temporary bottom because if you go back through history, there have been times such as 2022 where markets have actually rallied off these lows, and it's been what we call a false rally or a DCB, a dead cat bounce. Now, in technical terms, we've just seen that again. A rally up to the supply level, which we'll talk about later on today's video, and of course, a rally up to the resistance and area that everything could turn. And guess what time we find ourselves in? Earnings week, and a huge week in terms of also tariff discussions. Now, this brings us to something that we've used well over the last couple of years, and that is overlays. What is going on right now when you take a look at the 1960s, the 1920s, the 1980s to 2000 run? Are we still on path to make potentially a higher high? Well, as it turns out, as we know, probably the most closely correlated runs are the 1960s and 1980s into 90s runs. And both of those actually had fairly decent dips, as you can see here, exactly where we have found them. Now, they did tend to run further, and the key here is that they ran actually into what would equal around 2026 or late cycle kind of 2025. And in many of our thought processes, we thought that we might be able to get there. So you cannot discount that the market is possibly going to try to make a new high. It is possible, and of course, in bull cycles, we are in the last innings. This tends to be the period where you really want to be very, very careful. And we already knew this in 2025, 26, as we've been talking about together, that this was going to be one of the hardest times in markets that we've seen in years. Now, why is it so hard? Well, mostly because of these tariffs. I just want to read out a couple of signs here from Goldman Sachs, Jan, and I'm going to butcher his last name, Hatzius, I think it is. Now, in general, he says that there is never any positivity with tariffs. Now, let's just quickly hear him out here. Number one, tariffs increase inflation initially. Makes sense, of course. Goods come in, they have a jack price, and that can create inflation. Tariffs then result in deflation because tariffs are effectively taxes. And because tariffs are taxes on demand, that crunches down. As you can see here in the latest report, he believes there are going to be some significant impacts to the US economy. And of course, when demand crunch precedes deflation, that means that deflation occurs with a recession always. So basically, his opinion is pretty negative on the markets over the next 12 months. And this is sentiment that a lot of people have. The word recession has come up in more searches than I've seen since 2022 and 23. And of course, in general, everybody is going towards the so-called, in converted commas, safe haven. Now, you may have seen that chart that we shared at the beginning of today's video. And you also would know that if you've been watching the channel for the last 2 years, that our most bullish position on the channel has been gold. And don't get me wrong, I love gold. And as I've said, 3,000 and 3,600 are two of the targets that we've had based on cyclical analysis. Now, on top of that, we are starting to see signs of worry. And what that is it's not so much that people aren't talking about gold. Oh, they are. As you guys know, too many people are talking about gold. Take a look at this latest chart from Subu Trade. It shows here the value of call put volume in the last 2 weeks has absolutely skyrocketed. And gold is in what we would call an out of phase control kind of market. Basically, this is now moving way too many standard deviations from the general norm. And you may notice that when you tend to go into these types of markets, that you can be near the peaks. Now, to make things worse, which we'll actually do here, you can see that since kind of the last couple of times, 2016, 2020, 22, whenever we've seen this rate of change indicator go to these extreme highs, these 30 highs, that has been at least a temporary or even high topping point for gold. So are we entering into the same period? I'd love to know your comments down below. Now, don't get me wrong, still bullish for now. Of course, you want to see the signs of usually a market turning. And we always on this channel follow price action more than anything else because that is our number one. Data, seasonality, other things come after that. As I put in our advanced course and other things, of course, it's important to have a structural process, a repeatable process in time. But one other interesting thing was that when we tended to see this topping factor for gold, that sometimes Bitcoin started to play a little bit of catch up for a period of time afterwards. And this one here from Altcoin Screener, I thought was really cool. So yeah, I thought I'd chuck that in. Now, for people that are wanting to go super bullish on markets, of course, the super bull himself, Tom Lee and Fundstrat have come out with one of those bullish reads. I would, caution against this one. I love this read. Don't get me wrong. This is basically when S&P 500 percentage of stocks are above or below the 200, and then 25% are actually below that. So basically, we have a market where lots and lots and lots of stocks are oversold overall. Over 25% of stocks only 25% of stocks or less are actually above their 200-day moving average. We tend to see what we call a buy the dip process. Now, do I like that? Yeah, I do. I think it's actually an excellent indicator. The problem is this the time to be doing it in a concentrated market where it's so awesome? Well, that all comes down to risk management. And of course, whenever you're buying dips, you've got to be aware of the risks involved. And this is where things like Jason Gottfried's latest chart here, which is front VIX futures, is showing that still there could be some volatility. In fact, if you went to some of the worst periods of time, such as 2008, 2010, 2011, it could still be a very volatile next couple of months in these particular structures. Now, what we've been arguing recently is that we've probably come to a point where the market wants to structure up. And you can kind of see that with the results here when you're taking a look at the percentages. Now, some of them are insane. This 2021, of course, I think we can scrap that because that was the Fed getting absolutely wild along with central banks. But if you have a look at some of the others, you can see here that we have really a 50-50 style 3 months and a lot of up, down, and all around over the next 2 months. And this is kind of backed up with some of the data that we've been discussing. As you can see here, the worst performing 73 trading days since the 1920s. Again, till the year end, full calendar year, price return, full calendar year, not good. VIX high, yeah. The VIX over 11 times, not so good. And of course, the one-day return of over 9% that we saw only a week and a half ago now, that tends to bring a lot of up, down, and all around markets. Exactly what we're seeing right now coming into earnings season. There are some other signs. The McClellan oscillator here basically dropped down to negative 1,000. When that happens, it can be some form of potential buying period. And you guys know that, like anything, you want to stack as much evidence as possible. So let's take a look at the dark pools themselves, the Qs in particular. Now, we know we're trading in a range. The number 2 largest trade ever recorded at the highs here, and the number 3 dark pool at the lows here. And what the market has done is it's stayed within this range coming into earnings season kickoff. And we know that earnings season is going to be the key here. We've also seen the SPY with that huge trade that came in only a few days ago continuously start to find dark pools at around these highs at levels. And this really kind of shows us that there is a lot of differing opinions, I guess you could say, at these particular highs. Now, in terms of gold, would it make sense that we maybe are near the end? Well, the number 1 largest trade ever recorded in PHYS, which is the Physical Gold Trust ETF, came through as of late last week, or this week, I guess, at this time of recording. Now, why is this important? Well, the previous ones were accumulation buys. This one, yeah, it does look like it's a bit of a TP, and that doesn't mean that they're prepared to, that's the absolute top, and oh my goodness, it's just a warning sign that you've got to consider overall. Now, some good signs. We did see a massive trade come through KRE, which is regional banks, as of the Thursday close. That could be, of course, to do with the overall options flows and the OPEX, but still a big KRE post. And we will continue to look during this earnings season in particular for some of these really large trades, because there's probably going to be a sign here in dark pools over the next week of whether these markets are prepared to go more up or whether they're going to try to return, maybe even go to a low such as 4,700. One thing is generally sure in these stats, though, is we start to trade in a very wide range, but still we're in a structural building phase in these markets. Now let's talk about earnings. Yeah, big ones. Let's have a look here. Tesla is going to be wild on Tuesday. It looks like here we've got Enphase, we've got Intel, we've got IBM, we've got heaps and heaps of banks and other things. And of course, next week, what do we get? Even more tech. So these next 2 weeks in particular, with tariffs and uncertainty and future guidance, there are going to be so many wild things happening over the moves. And as you guys can see, the options market is very well aware of this. Have a look at some of these percentage moves. Tesla is expected to move plus or minus 11%, guys, on the earnings result itself. IBM is at a 9%, which is really high, and Intel is at a plus minus 10. That basically means if you're trading these stocks, be aware that the opportunity here on these particular stocks, including Google, are very high. These are some of the biggest vols we've ever seen coming into an earnings announcement. And yeah, it's going to be probably billions, hundreds of billions of dollars moving all around. Now, the question is, are we in a recession? Well, we mentioned before that we're probably hitting structure that is not good. We've lost things like Homebuilders. We've lost semiconductors as being the leads. And one of the ways you can see that is semiconductors versus SPY. We also know that it's kind of rare to hit a bear market without a recession. So although there could be a possibility of a new high, we cannot discount that this is a very worrying sign to be backing up with 2022 with another bull market, bear bust kind of thing in 2025. When they've been this close in the past, yeah, you guessed it, one of the correlation periods. So yeah, we've got a special on that coming up. We will be talking about it. Let's have a look at the defensives. The defensive nature of Thursday was clear. We had staples, we had utilities, we didn't have healthcare because of the concerns about tariffs, but we did have still a little bit of defensives coming through. Last 5 days, really all round and up and down. Semis and tech at the bottom, which traditionally means that it hasn't been risk on as we hit this risk. So what's really happened is we kind of came up, we had the number one largest trade on the SPY, and then we've done this. Okay. And as we've done this, markets have kind of gone a little bit more defensive. So we have to be aware of that coming to earnings. Now that's normal for a market to do that. It's pretty key. But at the same time, we even dropped some liquidity late last week, which we've been talking about, and some liquidity fell out of the market as we're at these levels. Now, of course, what we need to happen is we need Fed liquidity to increase. And if Fed liquidity doesn't increase, especially over the next 1 to 2 months, we're losing one of the big backbones that tends to get us out of these declining markets. So tariffs, earnings, liquidity. These are the 3 things that we're going to need to track. Let's have a look at the S&P 500 from the market action. We got, of course, a gap up, 2 candles here around the daily 20, which is a very critical resistance zone. And then we gapped down, sitting around the 5200 to 5250. Now, we had a suspicion that 5250 would hold throughout Thursday. Why? Because, of course, it was highly likely based on the put walls themselves there. But if we don't fill this gap and we don't get above this high, and then, of course, get above something like a 5800, we're not really out of the danger zone. This is going to be where the bears sit right now for markets, and you cannot discount the chance of a 4700 happening. It's statistically probable based on that 9% day. Remember, when we get those huge spikes in markets, it usually means the market is so insecure about what's going to happen next that you get tons and tons of profit taking and flows all over the place. Here are the latest options, high and lows. One of the key levels to look for when the market opens is going to be 53.90. If we manage to break above that, you can see here that we're getting above the options high level. We're changing structure. We're filling the gap that's sitting there, and we could be moving towards that big zone, 5600, 5670. Now, that is the most traded zone in terms of structure on the way down. On top of this, if we end up dropping 5200-ish, then we open up the possibilities of a 4700 low. So you can kind of see why we're at what we call the neutral zone right now in markets, because we do not have a clear direction on which way this market wants to go. The bears would argue that we're still in decline, and rightfully so. Higher time frames would now have a downward trend. However, the bulls would argue that we haven't touched the most traded zone and that we haven't really seen some of the general puts float out of the markets. The fear is still there. And you can see why when you look at the options market. 50 to 50 to 5300 remains the most written put wall. And 5200 as well is a massive put wall as we go through into May. So basically, there are tons and tons and tons of people trying to benefit from being a bear. And whenever this tends to happen, the markets like to do this more. Why? Because they like to steal money. And of course, in many ways, that's what smart money is doing right now. They're playing with it. Now, remember, if we're talking about the smartest money, we always say, do what they do, not what they say. Jamie Dimon, yeah, okay, he was selling a bit at the highs. We've seen Warren Buffett obviously famously cash up throughout the last 12 to 18 months, and he's now sitting at like 26% of his entire fund in cash, which is historically the highest level he's ever sat as a percentage of cash. So if you trust Warren Buffett on that one, you've got to be a little bit more careful about this dip, more so than ever before. He always says never bet against America, but at the same time, he is cashing in a little bit and has been doing so for some time. We've obviously shared that. It's over on our X as well. So the key levels to watch are going to be this 5300 to 5250 on the Monday trade. And why is this important? Well, of course, this level here is going to hold the markets up if it can do so. Let's move over to Tesla. Same kind of thing across the stocks. Tesla at 240, that's the put wall for this week so far. 220 underneath that. And 100 for NVIDIA, we're trading at 101.50. So markets are still at what we would call put wall bases. Now, if they give those up, they're going to go super negative gamma. And as you guys know, that creates a cascade or waterfall effect. So we could see, something like on the markets, 5,200 on the SPY, we drop that level, we end up at 5,000 pretty quickly or something like this. So you've got to remember the key is here to understand that if markets are given up, that there's this level of equilibrium where there's just a no-go zone traditionally underneath those, at least when you're looking at the stats. What about the bonds market? Is that happy? Not really. I mean, you can see here the bonds market, while recovering a little bit here on my risk indicator, hasn't really shown us that anything is hunky-dory yet. So, of course, we're going to need to be looking for that. Homebuilders, obviously still very weak. Number one trade up here. Weakness. Blue structure out a little while ago. So, obviously, that's key. And when it comes to things like option spread and high yield junk, you can see here that although risk has come out of the market since tariffs were suspended for 90 days, it's not gone. It's not really properly gone yet. And this can signify bottoming structure in markets. So the good sign for the bulls is that this can signify bottoming structure. Now we need to break through some of that resistance, that supply in the markets, to really solidify the price action itself. Now, we mentioned before that gold is one of our favorite metals. It totally is. But have a look here at the rate of change. Whenever we've seen it go over 30 in history, you can see here we've seen that happen quite a few times. And Seth Golden over here also likes this one as well, and so do I. That is that basically we can see that gold tends to not really do that well in the future when you compare it to the S&P. And it can also top gold off, at least temporarily. Now, notice here that we've just hit this. Can it get crazier? Yes. And markets can stay irrational longer than you can remain solvent. Have a look at this jump in particular, or go back into the 70s and see how wild that got. I mean, over here you can see, whoa, people don't quite understand how crazy gold went back then. So yeah, I mean, I think this puts in perspective that yes, okay, this is an important level, sure, but is it the high of the markets? Not necessarily. It's the danger zone. So this usually means this is where you don't really want to get involved anymore. You want to either be short, sharp, and sweet on this type of stuff, and you need to be on the lookout of what we call a blow-off. So I would say that that's probably something we're looking for in markets. We're also checking out dollar in general. Dollar actually broke low. It is oversold. This is not a great sign, but I would say this demand over here is the one I'm looking at most closely. So we're wondering whether there are any bulls left in the dollar. Again, no structure to say there are, but we'll be watching. Gold did have a mega week. You can see here on the candles, this was huge. 2 massive candles now. So we keep watching it. They're big though. They are big. You scroll over. Yeah, that's some unusually large candles. They're very large. So we have to continue to, of course, treat it with respect. And silver did okay. It ended up the week kind of like a long leg doji. No real decision. Silver could start to play catch up to gold, but it's going to need to break 34.20. So we've got that as our major resistance. And for now, we still remain bullish on silver, and we hope that it can get up to those levels. Now, for a lot of people, you would probably be pretty happy if you're in oil right now, but, still a bit scared, I'm sure. The inverse head and shoulders confirmed through and obviously is trying. Let's see if oil ends up bouncing up. Now, this is counter to what a lot of people believe, but at the same time, it is an inverse head and shoulders. It is totally against trend generally. And you can see here the weekly was already starting to confirm that. So will we hit 70 again? It's possible. We also have Tesla here. Obviously, Tesla, a lot of people try to trade this. 240 seems to be the put wall, then 220, then 200. So every $20 matters there. And on the top end, I would say still the 280 and just under 300. So like 295. They're the 2 key zones that I would be looking at most closely right now in the market. So that's, of course, going to be that key level you want to be watching. Now let's move over to semiconductors. They continue to be bad. Let's be real. This is pretty much where the trade war is right now. Semis. We need to regain control. And one of the key charts that you should be looking at on semis is semis versus SPY. And this is going to show us whether markets are actually showing any signs of leadership from the semiconductors. That is no longer there. Hasn't been there for a while. We're just not seeing it. NVIDIA, of course, another key. This is the semi that tends to start it all. Most traded zone, 115. Too much for it this time around. It's pulled back. One of the things I'm playing with is maybe a Fibonacci, like 61.8, like the golden fib. Maybe we get down to 97, 100. We start to find buyers again. Certainly worthwhile watching this as a day trader on charts. but we do know that 100 currently is the put wall for the week. Now, some other things that are interesting, PLTR came up. Obviously, we saw in the previous video, massive trade came through on it, big resistance. Could it be the end of PLTR? This is a very bad sell-off. Obviously, this is a resistance or supply, something worth watching into this earnings week. And just remember as well, guys, we have a lot of big earnings. So ultimately, it's going to be that most markets will be sitting at either key supports or very neutral zones. And even when you look at something like a Google, like again, it's going to be sitting around this 150 probably into earnings. And if it goes well and it busts through this 164, 165, that could be a really good sign that markets are starting to recover for a proper recovery. And of course, we'll be looking. HSI, Chinese stocks still look okay. Obviously, they went to a perfect level for buyers and they've retraced some. The big concern here is the delisting of several Chinese stocks and what that will mean. We'll be covering that this week. And of course, NASDAQ, we're looking at 18,700 on the buy end. And for the sellers, we're probably looking at somewhere around 17,950. And if we manage to break below that, then of course, it could get pretty nasty pretty quickly. So just remember, markets are currently trapped within price. We're looking for the big move. The key is, well, 19.6 on the most traded zone for the NASDAQ. So that's going to be the zone that's probably going to correlate somewhere with 5,600 on the SPY should we be able to get there. US 2000, it's holding pretty well considering nothing though that I see on this one that I'm like, wow, it just looks like it's kind of like chilling, waiting for further news. Is it oversold? Sure. Did we see a 2050 cross? Sure, but nothing really to write home about. And Bitcoin, well, it continues to do okay, kind of correlating here with equal lows, slightly higher lows now, putting pressure on the 86. If it is to complete the double bottom we've been discussing now for well over a week and a bit, then we're looking for that 88, 89. If we manage to get through 89, then we're looking at a potential swing trade, position-based trade, style improvement. Structure will finally change towards the upside. And that, again, could be an early warnings or early good sign for markets. So we're still in limbo, and there's no doubt that the bears are still fairly much in control of most of these markets. In terms of when you're looking at this week, just remember there are a lot of bank holidays throughout the Monday session. So you've got to keep that in mind. So that will be very, very important when you're looking at overall liquidity. And of course, when you're scrolling through as well, we do have a lot of news coming out of Europe, and we've got some US news. We've got other bank holidays coming in near the end of the week. And then we have really basically earnings. So yes, there are other bits of news around, but really it's going to be earnings, it's going to be tariff discussion, and that is going to dominate the news this week. And we are in a news-driven cycle here. So just remember, expect the unexpected, risk manage as much as possible. If you enjoyed today's video, please remember to sub, guys. Massive smash to the alert button as well. We will be live streaming, I believe, the Open here this week as well for free. So make sure to check that out in terms of the first one. And also follow us over on X and other things. To summarize here right now, I guess the way that we look at it is we've come back to a point of neutrality. The market is clearly trying to figure out what it wants to do next. And we have bashed and smashed quite a lot of recessionary structural zones. So the issue is, if we do want to follow a bullish path, we need to find buyers in this area. And why is that? Because you saw that Cisco chart and many other correlations. And yeah, it doesn't turn out well. So what happens here, especially over the next 1 month, is going to matter. Make sure to sub to the channel, and we'll be there every step of the way with you guys. Bye for now.